Is it all just random? A flip of a coin? You buy a stock, and you hope. You watch the news, you analyze charts until your eyes cross. But what if there was a mathematical way to see through the noise? What if the market, in all its chaos, had a predictable heartbeat? Today, we're not just looking at charts. We're going to decode the market's hidden memory using a powerful concept from mathematics called the Markov chain. And we're going to prove it works with real academic research. Most trading models tried to do too much. They used dozens of indicators, moving averages, RSI, volume, trying to predict the exact price of a stock tomorrow. It's incredibly difficult and often fails in the long run. But what if we asked a simpler, more powerful question? Instead of, what will the price be, we ask, what state is the market in right now? This is our first breakthrough. As shown in research on markets from Nigeria to China, we can simplify the entire market's movement into these three core states. This is the foundation of everything that follows. The market is like this goldfish. It doesn't remember the crazy bull run of 2017 or the crash of 2008. But where it is today gives us a massive clue about where it might go tomorrow. This is our crystal ball. It's called a state transition matrix. Each number in this grid is a probability. Look at this real data from the Nigerian Stock Exchange. If the market is in a stable state, it has a whopping 98% probability of staying stable next week. That's not a guess. That's a calculated probability derived from years of data. By chaining these probabilities together, this is why it's called a Markov chain, we can forecast the probabilities for any future date. This is the Holy Grail, the limiting distribution. No matter where the market starts, whether it's crashing or soaring, this research found that in the long run, the Nigerian stock market would be in a stable state 76% of the time. This is profound insight for long-term investors and pension funds managing risk. If the model tells you you're in a strong up state with a 93% chance of persistence, that gives you confidence to hold or even add to your position. You're not guessing, you're playing the odds. When the market is in a down state and everyone is panicking, the long-run distribution shows you that stability and upward movement are almost inevitable. It helps you stay a course. Now, it's not perfect. The model assumes the market's behavior is consistent. But as data showed, and as the GARCH model confirmed, volatility clusters. A major news event can create a shock that changes the rules temporarily. A smart trader uses Markov chains as a core compass, not a perfect GPS. You don't need a PhD to play with these ideas. You can start simple. Take a stock you like. Download its historical closing prices. Define your three states. For example, if the price moves up more than 2%, it's up. Down more than 2%, it's down. Else, it's stable. Go through the history and count the transitions. How many times did up lead to up lead to down, etc. Build your own 3x3 probability matrix. This is your model for that stock. So, what's the takeaway? Markov chains won't make you right 100% of the time. Nothing will. But they shift you from being a gambler, hoping the dice roll their way, to being the casino, who knows that over enough trades, the odds are firmly in their favor. If you enjoyed this deep dive, smash that like button, subscribe, and let me know in the comments what other trading concepts you'd like me to break down. Thanks for watching.